Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week focuses on Nigeria's Q1 2023 GDP report. Last week, the National Bureau of Statistics (NBS) published Nigeria's first quarter 2023 gross domestic product (GDP) numbers. The Nigerian economy grew for the ninth consecutive quarter, albeit at a slower pace. Real GDP rose by 2.31% year-on-year, that is, Q1 2023 versus Q1 2022, lower than the growth of 3.1% year-on-year recorded in Q4 2022. The slow growth in the first quarter was mainly due to the cash crunch brought by the CBN's redesign of the Naira, as well as new cash withdrawal limits. GDP tracks how an economy performs and measures the value of all final goods and services produced in an economy in a given period, usually a quarter or a year. Real GDP reflects the actual value of goods and services produced without the influence of price movements. Simply put, the GDP of a sector can be affected by both the volume of goods and services produced and the respective prices. Nevertheless, what's important is the increase in goods and services produced rather than the price increases. Nigeria's GDP report captures 19 sectors, but only 5 sectors account for 70.8% of the total activities in the economy. These are agriculture, 21.4%, ICT, 17.5%, trade, wholesale and retail, 15.8%, manufacturing, 10%, and mining and quarrying, 6.2%. The non-oil sector, which accounts for 93.8% of Nigeria's GDP in Q1 2023, remained the driver of the GDP. The non-oil sector grew by 2.8% year-on-year in Q4 2022, down from 4.4% year-on-year growth in Q4 2022. On the other hand, improved security efforts started to pay off in the oil sector as oil production volumes increased to 1.51 million barrels per day from 1.34 million barrels per day in the fourth quarter of 2022 and 1.49 million barrels per day in the fourth quarter of 2022. While the sector recorded its ninth consecutive contraction, it was less severe at minus 4.2% as against minus 13.4% in Q4 2022 and minus 26% in Q1 2022. Based on the contribution of sectors to GDP, the services 57.3% in Q1 2023 versus 56.2% in Q4 2022, and the industrial 21.1% in Q1 2023 versus 17.3% in Q3 2022 sectors picked up momentum, while the contribution of the agricultural sector declined. 21.7% in Q1 2023 versus 26.5% in Q4 2022. The industrial sector recorded a growth rate of 0.31% year-on-year after consistently being in the negative territory for over 6 quarters. Growth in the services sector remained strong at 4.4% year-on-year in Q1 2023, although the lowest in the last 4 quarters due to contraction in the insurance sector. On the other hand, the agricultural sector was in the red, minus 0.9% year-on-year in Q1 2023 versus 2.1% in Q4 2022 due to the cash crunch. Here are our takeaways. 1. On the back of the cash scarcity and election uncertainties in the first quarter, 4 out of 19 sectors, agriculture, mining and quarrying, administrative and support, and other services, recorded negative growth rates. Also, 10 subsectors followed similar trends. 2. The agricultural sector recorded a negative growth rate for the first time since 2016 due to the cash crunch in the first quarter. This emphasizes that transactions in the sector are still largely cash-based. Based on the huge contribution of this sector to the economy, the banks and telcos need to come up with seamless solution to boost the adoption of non-cash payments. This will save a lot of man-hours and improve productivity in this sector. 3. While we recorded an improvement in oil production to 1.51 million barrels per day in Q1 2023, higher than 1.35 million barrels per day in Q4 2022, this is still a far cry from the OPEC quota of 1.8 million barrels per day and below 1.69 million barrels per day assumption for the 2023 approved budget. The depressed growth in the crude petroleum and natural gas sector can be attributed to low crude oil production due to theft, prolonged operational and maintenance issues, as well as divestments of international oil companies, IOCs. 4. Growth in the ICT sector remained strong at 11.7% in Q1 2023 on the back of higher investments in 5G, improved data revenue, increased subscriber base, and improved activities in the payment services segment by the two giant telcos. 5. Aside from the constant drawback from oil refining in the manufacturing sector, 3 other sectors, textile, electrical, basic metal and iron, joined the pack, dragging the sector's growth down to 1.6% in Q1 2023 from 2.8% in Q4 2022. 6. Still on the cash crisis, the trade sector grew at a slower pace, 1.3% in Q1 2023 versus 4.5% in Q4 2022 and 6.5% in Q1 2022, traceable to the huge dependence on cash for transaction. Overall, it's obvious that the CBN's redesign of the currency and cash withdrawal limits policies slowed down the economy in the first quarter greatly. Unfortunately, this was avoidable. The extension of the deadline to December will serve as a major boost for greater growth in second quarter of 2023. We project a 3.1% year-on-year growth in Q2 2023 due to an expected improvement in business activities and the successful completion of the general elections. However, higher taxes and finance costs will weigh on the manufacturing and agricultural sectors. The immediate policy announcements of the new government assuming office this week will also play a major role in boosting confidence in the economy. It's noteworthy to stress that we need to grow above 5% for Nigerians to experience inclusive growth. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed.